Hi guys, welcome to a market structure basic class. Today I'm going to be teaching you how the market moves. As a forex trader, as a cryptocurrency trader, you will need to understand some of the foundations of forex trading, and one of them is called market structure. Now, market does not move in a secular way, neither does it move in a square-like pattern. But just like you can see on the screen, when the market moves basically in three ways. It's either the market is bullish, it's either the market is ranging or consolidating, or the market is bearish. Now, today we're going to be looking at these three major structures, and I'll be telling us about major structure, minor structures on the lower time frames, the break of structure, the market structure shift, and how to get entries, like a professional, using market structure. Where do you enter? Where do you exit? All of this will be covered in this teaching. Now, we're going to begin from the bullish market structure. So when we say the market is bullish, we simply mean that the market is pushing to the upside and is creating what we call higher highs and higher lows. Now, this is a clear example of a bullish market structure. We see the market move impulsively, the impulse, and then we see a correction. We see impulse and we see correction. We see impulse and we see correction. This is what we call the correction phase, while this is what we call the impulse phase. Now, market does not move in a straight line, like you might have already noticed by now. You will notice that market will move up, it will enter a correction phase, it will move up again, it will enter a correction phase, it will move up again, and then enter a correction phase, and so on and so forth. Now, whenever we're in a bullish market, it must create higher highs and higher lows. What do we mean by higher lows? Which means the new low formed will be higher than the previous low. Just like you see, this higher low is higher than this higher low here, and this also likewise. And in the same way, your new higher high will be higher than the previous high. Your new high will be higher than the previous high. You see that? So that's it. This is what we mean by a bullish market structure. So when you see this structure in the market, we can say the market is bullish. Before you start trading any day, when you open your trading view or your MT5, the first thing you must do is to determine the market structure. You don't just open the chart and start trading. You must determine the market trend so that you can trade with the trend. You don't trade against the trend, but you follow the trend. You follow the trend. Don't ever make the mistake as a forex trader to trade against the trend. But why will you not trade against the trend if you are not even able to determine what is the market trend? So you must be able to look at the market, the chart, and identify the trend of the market. And that is what we're trying to learn today. So this is a clear example of a bullish market structure. Now, this is what we call a bearish market structure. Now, in a bearish market structure, the market is creating what we call lower highs and lower lows. So you see the market begin to dump from this point, created a high here lower than this high. So you see that, and then continued dumping, formed a lower low, pulled up and formed a lower high, pulled down, formed another lower low, pulled up, formed a lower high, pulled down and formed a lower low. Now, what you will notice in this market is that each new lower high is lower than the previous high. That's why it's called a lower high. And each new low is lower than the previous low. when you identify this in the market, we'll say the market is bearish. It's bearish. When the market is bearish, we look for selling opportunities. We can look for temporary buying opportunities within these areas, but basically the market is moving from the top to the downside, while in a bullish market, the market is moving from the bottom to the upside. So we look for buying opportunities and temporary selling opportunities during the correction phase. Now, another way the market can move, remember I told us the market can move only in 3 ways. Now, another way the market can move is what we call a ranging market or a consolidating market. When the market is ranging, the market is simply just moving up and moving down within a resistance and a support level. So you will see the market go up, come down, go up, and you must not necessarily get to the support, but you keep seeing this pattern in the market. Personally, some scalpers maximize ranging or consolidating markets. I do not trade during ranging or consolidating market, and if you are a new trader, I will also advise you to stay away from the market during ranging, when the market is ranging or consolidating. So these are the 3 ways the market moves. It's either the market is bullish, bearish, or what? The market is consolidating. All right, so I believe you have been able to grab this for now. Now we have what we call the break of structure. And now let me explain what we mean by the break of structure I'll explain it both from in the bullish market and also in the bearish market. Now, we noticed an impulse, and then the market moved into a correction phase and then formed a new high. Now, we noticed that the new high here broke the previous high. What I mean is that it went above the previous high. Likewise, this new high also went above this previous high. Now, this point at which this market broke and formed a new high is called a break of structure. So this is your break of structure. This is your break of structure. So break of structure. So this is your break of structure. Let me clone this. Call this BOS. BOS, break of structure. Let's clone this. Break of structure. So you see that now. So the point at which this market, the new high, broke above the previous high is what we call the break of structure. We can also see that in the bearish market. So when the market is bearish, you see the price moves this way and then forms a lower high and then comes to form a lower low. The market breaks structure at this point. It breaks the previous low and forms a new low. So when this happens, we say there is a break of structure. Okay. All right. So this is a break of structure. Let me clone this. This is a break of structure. Another break of structure. Let me clone this. This is another break of structure. So in a bearish market, when the new low breaks to form a lower low, we call it a break of structure. This keeps validating that the market is still bearish. The market is still bearish. So now we see, okay, let me label this also the same way we labeled it in the bullish market. So we call this our BOS, break of structure, and then break of structure. So in a market like this, whether bullish or bearish, traders will often draw a trend line, something like this. You see this? A trend line, trend line, something like this. Okay. So that's a trend line. Let me move this up a bit. Okay, so this is a trend line. So you see that in a bullish market, the market moves upward, comes back to that trend line, pushes to the upside to form a higher high, corrects, and pushes up from that trend line to form a higher high. Now this can be a very good method for getting your entry. I remember there was one day I opened my chart and I noticed a pattern like this, and it has already formed two higher lows, and it came and hit my trend line, and I noticed on a lower time frame that the market was turning from as a change of character has taken place, changing the structure of the market from the correction phase back to the impulse phase. And I entered for a buy around here. I entered for a long position around here, and then I put my stop loss around this place, and then I targeted above the previous high, and interestingly that trade went straight to take profit. So you see that can be an entry model, but to be on the safe side, there are many other things that can be considered before entering. So but we have not gotten to the point of showing you how to enter yet. So you see, the best point to enter in this bullish market, if I'm looking for a buy position, a long position, is this point. I take a buy here, I put my stop loss below the trend line, and then I target above this previous high. You see that? Yes. So that's how we get long position, buying positions in a bullish market. Now, what of a bearish market? Let me move to the bearish market. Now, in a bearish market, we can also draw our trend line, and then draw our trend line. You see the market creating lower highs and lower lows. Now, if this market is dumping from this point and then it pushes to the upside, and taps our trend line, and then pushes to the downside, and then it comes back here and taps into our trend line again, I can decide to take a sell from this position. I take a short position, open a short position from this point. I set my stop loss a little bit above it, and I target below the previous low. Can target below the previous low, and you see, to go straight to take profit. So this is what we mean by the bearish market structure. This is what we call a trend line. 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 All right. This is what we call a trend line. Okay, so I've told us that the market moves basically in three ways. The market is either bearish, bullish, or ranging. Now, for those that are scalpers, they will wait for the market to move from this point to this resistance level, and then come back to the support, come back to the resistance level, and then they can decide to take a sell from this resistance level down to this point. But like I've told you, I don't trade during ranging or consolidating markets because there are a lot of technicalities to it. Anything can happen in a ranging market. There are people who are breakout traders who in a ranging market they are simply waiting for the market to break out before they take their entries, while some trade the ranging market itself. Some wait for a breakout either to the upside. They wait for a breakout either to the upside, and then they wait for the market to retest the resistance level, and then they'll get a buy to the upside. While some will wait for the market to break out, below. So whether it breaks out above or below, breaks out to the downside, then they wait for it to come and retest the support level, and then with clear confirmation, they open a sell position to the downside. So we have the breakout traders who, when they identify a ranging or consolidating market, they are waiting for either a breakout to the downside or a breakout to the upside before they get a clear entry, whilst a lot of scalpers trade ranging markets. Now I want us to go into the charts because most times you might not see something as clear as this on a lower time frame. In the higher time frame, we're going to look at gold, the 4 hours time frame, and then we're going to try to identify the market structure, and then we're going to go to the lower time frame, and you are going to notice you may see something like this. So this is a minor structure in the lower time frame. Now you see, for instance, in the bullish market, you see the market moving to the upside. Now when the market is moving to the upside like this in the higher time frame, what you are going to see on the lower time frame is going to look something like this. This is how it's going to be creating this impulsive movement. Is going to be creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? And then this correction phase is going to begin to create lower highs and lower lows. So bullish and bearish. Now if you notice in this my minor structure, you will notice that when the market shifted to a bearish trend, you will notice that the low here broke. Now for it to continue in an uptrend, we need to see a higher low at this point. But you notice what the market did. It pushed to the downside and broke our previous low. So we mark it. It broke our previous low and kept pushing to the downside. Now since the market has broke our previous low, this can be an indication that the market wants to shift from an uptrend to a downtrend. Now this point is what we call our MSS. So a market structure shift, and then you notice what happened. The next upward movement did not break above this high, rather it formed a lower high and then began a downward trend, and then the downward trend continued to this point, and then we notice what happened. It created a high that broke above this high. Breaking above this high is also a sign, that a possible sign that the market is about to shift from a downtrend to an uptrend. So you see that now. So this is what you will likely see in the lower time frame. So like I said, the market does not move in straight lines. It creates patterns and structure as it moves. Now I want us to move straight into the chart and see examples of what we have learned today. So let's move to the gold chart. This is XAU USD. This is the 4 hours time frame. Now let us identify the trend of the market from the 4 hours time frame. Now in the 4 hours time frame, you will realize that the market was bearish from this point. We see a bearish trend from this point, a bearish trend from this point, and then the market got to this level and then began to create a pattern. So let's do this. The market pushed up from this point to this point. It pushed down to this point and then pushed up to this point, came down to this point. The market also pushed up again to this point, pushed down to this point. Now we see the market also push up to this point here and then pushing down to this point at the moment. Now we can clearly see that the market currently is in what we call a bullish trend. So this is a clear example of a bullish trend. We see a clear break of structure here. We see a clear break of structure here. We see a clear break of structure here also. We see a clear break of structure here also. So this is an example of a bullish market. An example of a bullish market. Now let's realize something. The market was previously bearish. Now this point here is the last low in the bearish movement, the last high in the bearish movement before it began to create, before the market switched bullish. Now you notice the confirmation is that the market cleared this previous high, created a new high, pulled to the downside and created another high. Now this is a clear sign that the market is about to shift from a bearish trend to a bullish trend. So you can see there are several examples in the market. Several examples. You can see this is a bullish market. So this is a bullish market here. You see a bullish market. The market pulled down, was bearish down to this point, came down here and began to create higher highs and higher lows. Higher highs. See that. Low to this point. Then so this is a clear bullish market. Now this is a clear bearish market. Now let's look for an example of a consolidating market on this chart. You can see a clear example of a consolidating market on the 4 hours time frame. You can see in the 4 hours time frame at this point, you can see this box. This is a clear example of a consolidating market. Market moved from the upside to the downside, pushed up, came down again, pushed up within this support and resistance and support level. Now you notice what happened. The market has broken out above that range. All right, so this is a clear example of a ranging market. Okay, now let's look at the lower time frame. Let's look at the 1 hour time frame. Let's look at the 1 hour time frame market structure. So this is what it looks like on the lower time frame. So you see when the market was in the pullback phase, you see what the market did, selling from this point to this point, created a high here, continued selling to this point, created another high, and then continued selling continue dumping to this point. The market created another high here, and then did what? Continued dumping, created a lower high, continued dumping, created a lower high, continued dumping, continued dumping. I think it created somewhat of a lower high here also. Continue dumping. Alright, so this is a clear example of a bearish trend, and then we can see a bullish trend here. The market pushed to the upside, pulled back, correction phase, pulled to the upside, broke this high, which indicates that the market is about to shift bullish, created another low. But you notice that this low is still, this lower high is higher than this low. That's a bullish market. And then began to create higher highs and higher lows, higher highs, 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 higher lows. So we see the market is clearly bullish at this point. And this is the market consolidating. You see it here on a 1 hour time frame. This is it. See the market consolidating on a 1 hour time frame. Now the market broke out of this, so breakout traders were waiting for this confirmation. The market broke out of the consolidation. You see it now. The market broke out of the consolidation, and then breakout traders were waiting for this to come and retest this. That's what you are seeing already here. You wait for this to come and tap this zone, and then they wait for a confirmation. If there's a clear rejection, they get a buy, further buy to the upside. So this is an example of a bullish, a bearish, and a consolidating market. This is our basic course. So you see, the best in a bullish market, how do you get your entries? In a bullish market, how do you get your entries? Let me just show you something very quickly before I wrap up. Now we noticed the trend was what? Bearish. Bearish. So you have a lot of buying, a lot of selling points at this place. For instance, there are a lot of points where you can decide to sell. Sorry, you can decide to sell from this point. You can decide to sell from this high. You wait for the market to, sorry, this is not a short position. You can decide to allow the market to create a new high, and then you begin to sell to the downside. You see that? Begin to sell to the downside. Begin to sell to the downside. You see that? So at this point you can decide to sell from this high, or you can decide to sell from this high, or you can decide to sell from this high. So that's a bearish market. You can have temporary bullish trends here, but I personally prefer to wait for a new high to be formed, and then I sell from that point to the downside. While in a bullish market, you wait for a new low to be formed. Now notice, like I told you, there was a market structure shift here, because this was a downtrend and the market pushed to the upside and broke the previous high, then pulled back. So you can decide to buy at this point. You can decide to buy at this point. Put your stop loss under at this point, and then you decide to target above the previous highs, because in a bullish market, the market will create what? Higher highs and higher lows. So at this low you target a new high. So for instance, In this market now, we see the market pulled back from this point down to this point. So this is a good point to open a buy position. Set our stop loss at this point, and then we target above the previous high. So you see how the market went straight to take profit. Another point you can buy is at this low. You see the market move down to this low, and then you can decide to buy from this low. See that, buy from this low, and then we target above the previous high. So that's that. So if there's not going to be a market structure shift at this point, then you can decide to also buy from this point and target above this last high. You see that. So these are clear entry positions on in a bullish market, and then we can see clear entry positions on a bearish market. We'll have a follow-up course on market structure, but this will be all for today. Thank you very much, guys, and have a wonderful day.